Hi, good afternoon all. This is my individual project presentation for UCLA Extension exploratory data class. What I decided to do was a rental real estate analysis. So quick overview, I'll go through the data preparation that I did, a couple different analysis segments here. The first one is going to be a vendor analysis, which I'll explain. The next one is going to be a property ROI benchmark analysis. And then lastly, some macro regression analyses. So my objectives here are about 4 years ago, I started as a real estate investor. So I wanted to evaluate the performance of my portfolio of my properties by basically benchmarking the ROI against some common indices, such as the S&P 500. And then when I did that, what I found is that the returns that I realized were highly correlated to home prices, specifically the housing price index, the national HPI. So I then wanted to see, explore some metrics, some macro financial metrics, and see what were some correlated controlling variables to the HPI. So I started this with the scientific method. I had 5 hypotheses. The first one is that the asset performance predictions provided by the vendors that I purchased these properties from were reliable estimates of what I actually realized. So basically, did I get what I bought or what I was promised? The second one is I hypothesized that my real estate portfolio outperformed the S&P. The third one is a common saying or a common mantra in real estate that single-family homes provide a steady stream of cash flow that can be leveraged for retirement planning. So I wanted to kind of assess the volatility of my cash flows. The fourth one, the hypothesis is that my returns are basically insulated from a down market. This is another thing said by real estate investors that, like, hey, invest in real estate. This is a good hedge against inflation. And if there's a down market, you won't lose as much money like you would in the S&P. And then the last one, kind of along those lines, I wanted to see if the housing price index was insulated from the volatility of the S&P at all. So the first part is data preparation. So for the macro metrics, I basically leverage Fred St. Louis, which are freely available metrics. I consolidated about 14 or 15 different metrics I thought might be correlated to the housing price index. I then added some additional variables, such as I created some variables such as the change in the S&P and the change in housing price index. That was to basically try and normalize the S&P and the HPI. The reason for that is because the current S&P index, or a couple months ago, was around 4,000, whereas the housing price index was around 200. So that made it kind of challenging to compare those side by side. So instead, I compared the change in the indices. I also created an indicator for if we were in a recession for a given month. And just a quick call out, all these metrics, the primary index is the month and year. So it's a Boolean variable I added to indicate if we were in a recession at that time or not. And then a couple other ones I added were another Boolean variable if the HPI or the S&P decreased in a given month. Just these were just a bunch of random variables I thought might be interesting, and then started to explore some of these, and we'll dig into that later. For the individual property sheets, there's a lot of data transformation from tax statements, owner's distributions, mortgage closing disclosures. So it took a lot of time, but basically what I got was a list of basically for each property, the month, the net operating income, the expenses, and then I added a bunch of variables such as like net operating, or a bunch of formulas like the net operating income, the total ROI, the cash flow. And then for each property every month, I benchmarked it against common indices such as the HPI and the S&P 500. I then wanted to compare a sample investment in the S&P. So, as an example, if I bought a property in like November of 2018 and I had some amount of cash flows and some amount of equity, I wanted to see if I'd put that money into the S&P instead, over time, how that would have grown relative to the returns of the property. And then the consolidated property sheet, I basically took all the individual sheets and put it in one, just to make things a little bit easier for the analyses. So the first thing I did when taking a look at vendors, basically, did I get what I was promised, is I just wanted to take a brief look at the volatility. So we can see here, this is net operating income, and it's kind of all over the place. So this is worse than I expected. So I definitely wanted to dig into this more. So then I took a look at, okay, what was the actual net operating income relative to projected. So we can see projected, basically what real estate vendors provide is like a single page Excel sheet that says for a given year, you should basically cash flow about, let's say, $200 a month for this property. So that's why the projected, a lot of the observations are highly, have a high density in one place, because they don't consider volatility at all. But what we can see, the actual way that those assets function is highly volatile. So right here, I basically saw already that projected NOI is way off from actual, but I wanted to get some specific objective metrics for that to validate. So then I took a look at each individual property over the life cycle of when I own that property. I took a look at what the projected cash flow should have been and what actuals were. So basically what we're seeing here is the projected cash flows is they kind of added a margin for error. So typically when there were no repairs needed for a property, the actual NOI was actually more than projected because of all the margins that these margins for errors the vendors put in there. But what we also see is that a lot of things happen with a property. So the NOI dips below zero quite a bit, and we can see there's a lot of volatility here. And then from an actual pragmatic evaluation standpoint, we can see R squared is extremely low. Basically, the takeaway here is that the projected NOI is way off from actual. So actually, it is highly volatile. And basically what was predicted from an NOI standpoint has absolutely no correlation to what the NOI actually is on a monthly basis. So I'm going to go through, I basically did this for every property, and every property, it's basically the same story here. The R squared is extremely low. And the projected NOIs have almost no correlation to the actual NOI of these properties. So once I saw that, I then aggregated everything in the entire portfolio, because there's kind of, I think a decent hypothesis to say, okay, individual properties might be volatile, but what if you have a bunch of properties? So I only have 3, but we can see even with those 3 properties, the R squared is actually worse than a couple of the individual properties. For instance, like property 2, R squared of 0.03, the portfolio as a whole is 0.005. So it's actually getting worse, which is not good for a lot of kind of people who teach this stuff in the real estate space. So my takeaway here is that cash flows, basically these series of graphs to me solve 2 hypotheses. So the one is basically these pro formas provided by asset vendors are way off. Is they're clearly not data driven. They're basically randomly guessing. And the projected NOI for the properties had almost no correlation to the actual. So this first hypothesis was falsified. And then the second one, that a real estate portfolio provides a steady stream of cash flows that can be leveraged for basically retirement planning, is also false. Is the cash flows are extremely volatile and highly variable. So there's really no way to predict what these would be in the future based on kind of the data we have here. So the next thing I wanted to look at is, okay, maybe NOI is variable, but what was the total return? Or were these at least decent investments? So I'll kind of talk through the variables that I incorporate here. So equity should be relatively straightforward. It's basically just the value of the home minus the mortgage. Cash flow from operations is basically a concept where it's saying, it's the rents received for that property minus the expenses. So it's the operations of that investment. Cash flow from financing would be one of 2 things. It would either be a refinance. So I get some cash from basically refinancing and getting another mortgage, or it would be selling the property. The total ROI is just basically the cash flow plus the equity for what that is. And then what I did is I benchmarked this against a levered S&P investment. So the reason for that is because I didn't feel it was fair to evaluate these houses versus just an S&P investment, because these houses are leveraged with a mortgage. So typically that allows for higher returns. So what I did is, at this point in time in 2018, it would have been pretty easy to get about a 6% promissory note or a private personal loan, and I could have taken that extra capital and put all that in the S&P. So that's basically what this is. So for the first property, we can see that this actually did not outperform the levered S&P, which is not good. The ROI is pretty high, 35% year over year, but we can see 94% of that was from cash flow from financing activities. So basically from the sale of that property, there was almost nothing made from cash flow from operating activities. The second property we see we did significantly outperform the S&P, but again, we see 94% of that return was basically from refinancing. And we'll see, this is basically the trend for these next two. This one also barely outperformed the S&P. This was a pretty massive ROI, 112%. But again, a really high percentage of that was from a refinance, cash flow from financing. So my concern here is like, okay, if the market goes down, I'm really not making much in cash. So are these really reliable from a cash flow standpoint? So then the last thing I did here is I basically took the total portfolio and I benchmarked it against the S&P. So we can see the portfolio did slightly outperform a 6% leveraged investment in the S&P, whereas a non-levered S&P would be significantly less. And then kind of continuing here, because we saw a lot of those inconsistencies with how little cash flow from operations there actually were, I wanted to take a look at the total ROI, which we see here in green. And I wanted to see how much of that was from financing, so sales or refinances. And we can see it's about a 10x multiple. So almost the entire return of this portfolio is based on financing. So that's going to be basically correlated to the housing price index, meaning if the housing price index falls and my property home values falls, I'm not making much money from these, is basically the takeaway here. So the hypotheses from that series of graphs were, first one, my portfolio outperformed the S&P. That is true. However, my returns are slightly amplified because I'm estimating equity. So that's not always right because I have to estimate home value. And then also in that estimate, for the houses that I still have and haven't been sold, if I were to sell, there's a bunch of fees I would get hit with there, which aren't included in basically the projections there. And then the next one is the returns of my real estate portfolio are insulated from a down market, which is something a lot of real estate investors say. That's also false. 90% of the returns were from equity appreciation, not from cash flow from operations. So if we do go into a downturn and my properties stop appreciating, these now kind of become not so great assets. They're not cash flowing much from operating activities. The next one I'll try to go through quick. So now, because I'm really concerned that the returns of my portfolio are highly dependent on basically the housing price index, I wanted to start to see, okay, what are some control variables that might influence HPI? So I took a look at mortgages since 1984 by quadrant, and this is basically what we would expect. So lower mortgages, for instance, the mortgages in the in the first quarter, that's up to about 6%. I think the first quadrant. So we would expect the highest housing price index because the lower mortgage means it's houses are more affordable, which means generally the values go up. So this is what we expect, but we do see some outliers here. So in a continued analysis, we probably want to explore this a little bit more because there are probably some other variables at work here. Next, I really wanted to take a look at an overview of the volatility of the housing price index versus S&P. So we can see there's a pretty huge disparity here. The housing price index is highly concentrated and this is the change in these values. So this is that custom variable I created. So we can see that the housing price index doesn't change much. It's very concentrated. The average change in HPI was about 0.37%. And we can see the S&P is way flatter, meaning there's a lot more volatility in the change. And the average is about 0.74%. So about a 2x change from the housing price index. So, you could reliably say, hey, like the housing price index, the S&P is a better investment, but we do have to consider the volatility here. So the housing price index is a lot more stable. So now I kind of wanted to dig into this more, and I wanted to see is the S&P correlated to the housing price index? Because the S&P 500 basically reflects the market premium or the US market. So we can see here, it is correlated. It seems to be linear correlated. R squared is 22, so that's significant correlation. But there's kind of a lot of noise around like 1500, 1700. So I wanted to explore that a little bit more. So what I did was I segmented this of an S&P value of around 1700, where the trend shifts. And what we can see here is in the higher values of the S&P, R squared is 0.95, so very highly correlated. This is a very reliable linear regression, where for every point increase in the S&P 500, the housing price index increases by about 0.04 historically. So, and this has been over the course of about 30, 40 years. But for lower values of S&P, the housing price index is both above and below. So the R squared is about 0.62. Because we have a lot of observations here, my takeaway is that it's not correlated, that this isn't a good indicator. So, I would want to continue this analysis here. I'd want to take a look at segmenting, especially the lower values of the S&P, and take a look at, is that a time thing where maybe back in like the 80s and 90s, it wasn't correlated? Or is that a reflection of market conditions? When markets go down, does the housing price index then have less of a correlation? So I didn't have time to do that here, but I would definitely want to explore this a bit further. So the finding here that the S&P is insulated from the volatility of the S&P 500, that's false. The HPI is highly correlated to the market, which means that in a down market, my portfolio would lose most of its value. If we remember, about 90% of the value of my portfolio was due to appreciation. So this is another falsified hypothesis that are typically touted by real estate investors. So the next thing, this is my last slide here. I just wanted to touch on, next steps for this is, I thought this was a great project. It took me about 20 hours and I frankly just ran out of time. There's a lot more that I wanted to do that I just wanted to mention here. So the first one is I'd love to dig in more on which macro variables are the highest correlated control variables to the HPI. So I didn't get much time to do that. I'd also want to add more properties and increase the data set of those to really make sure, like, hey, are my findings just kind of niche findings, or are these true across other people's portfolios, across other time periods? Yeah, the last one I wanted to mention here, for, I kind of compared actuals versus predicted for the NOI. I'd really love to segment that by geographies, so in different areas in this change, and also by different vendors. I'd love to get a list of a bunch of properties with a lot of different vendors and see, is this an issue where some vendors are just really bad at this and others are good? Or is this pervasive across the space where basically no one is really providing actual accurate predictions of how these assets perform? So that concludes my presentation. Thank you so much.